Hi guys, my name is Peter. Welcome back to Invest with Peter. So today I'm going to be talking about what I think is going to happen and what I think of what Jerome Powell said on Wednesday on the during the FOMC meeting they had on Wednesday, and I believe it's not been hawkish and it's not been dovish. Some people believe it's been hawkish, but I believe Jerome Powell is just being diplomatic. He's trying to kick the can down the road. But before we go in, my name remain Peter Ad. So please, if you've not actually subscribe, please kindly do put your comment down below, put that thumbs button up. That helps me, that helps the channel to grow, and that helps spread the message as well. So now let's talk about what he said. I believe Jerome Powell is trying to save the market at some point. At some point he has to do something, but I believe he's still trying to save the market. Well, time will tell. Next meeting is going to be March the 16th. That's where it's going to be actually coming out and say, well, guys, we have to raise the rates now at these base, 25 base, 50 base, and all that stuff. But market believes he's going to be raising rates. FOMC be raising rates 4 times this year, and some are even talking about 7 times. I was worried when I had that 7 times. That's a lot of. But the only time will tell, because we don't actually know now if actually it's going to be raised more than 3 times. But I believe we're still going to see this correction. Anyway, we're in the bear market now. You all saw what happened on Monday. Market went down straight away. But, well, I don't want to bore you. I want to listen to what he said on Wednesday.
Averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March. In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer-run goal, The economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks.
Well, guys, welcome back. You've all heard what he said, but briefly, I'll summarize what he said, right? Sorry if you see me looking around, like I'm just looking at where I, drafted everything. I summarize everything now. So I'll be looking. If you see me looking aside, I'm checking my jotters because I don't want to miss anything. So he said, they won't raise rate until March, right? So people were believing he's going to come out and say, yeah, we're raising rate today. He said, rate is going to be raised during March meeting. So that's one of the things he said. Another one he said it's possible to raise the rate without affecting the labor market. I don't know how that's going to work, but that's what he said. Well, I believe once they raise the rate negatively, it's going to affect the labor market, whether we like it or not. Inflation is going to be, be affected. The people are going to, are going to be affected. And you saw what's going on in US. They call it the Great Resignation, where over 4-point-something million people have already, left their job. They're like, yeah, I've had enough. I'm moving away. I'm moving on and all that. So they're moving on to better opportunities. So that has actually affected, some sectors, and those sectors were thinking, well, we can get people to work for us. Those who are working are calling in sick because of the Rona going around, and all that stuff. So labor market is really, really been affected, and it's really, reflecting in the stock market. So he said it's possible to raise rate without affecting the labor market. I don't know how that's going to work anyway. So as he said the supply chain issue is not going away very soon. So he's trying to forecast that till 2024, we might still be going through this chip shortage. Vehicles, the companies can't get hold of, chips to put in the vehicles. Electric vehicles been affected. A lot of them. Tesla came out with their earnings. It was really very good, but Elon Musk was warning that it was really hectic, because supply chain and all that. So it's been a lot of problems, a lot of issues getting chips, all around and all that stuff. But regardless, it beat the expectation and all that stuff. So many, even McDonald's came out like they have to increase their workers' pay because they can't get hold of worker. People are leaving, so they have to increase the pay and all that stuff. And McDonald's stock went down because of that, because they missed some of their report and all that stuff. But this is really reflecting in individual people, in individuals. Common people are really like being affected by inflation and all that stuff. So I believe Jerome Powell is not really concerned. He's not really worried about people who are like a millionaire or people who are like doing well and middle class. He's worried about the common people, what they're gonna be facing. Gas is gone up. Energy price is gone up and all that stuff. So people are really being affected. So he's trying to say, well, we can raise rate and it's not going to affect the labor market and individuals. Well, only time will tell. So he said the asset purchase, right, it's going to end, by March. So, well, we can. He's not a politician, but well, let's take his word. He said they're going to stop asset purchase by March. Time will tell again. So another one, he said they won't reduce the balance sheet. They won't let it run out until they meet after March the 16th. So the next meeting now is March the 16th, right? So he said they will not discuss about the balance sheet being running off until after the next meeting. So, well, because somebody was asking him like, okay, what do you think about the balance sheet being getting run off and all that? So, but he said they're going to be discussing that in their meeting just after they come out on March the 16th or FOMC meeting. So, well, to me, it's like a doom and gloom, and some analysts were worried that he's being hawkish. But what if this guy come out on Wednesday and said, okay, we are raising the rate today? So that's being hawkish, because market was not expecting them to raise rates on Wednesday. But what if he comes out and say, we've discussed, we've planned that we're going to be raising rate today, and market straight away market goes down into correction, and because market need to price that in as well. So to me, it's been diplomatic. It's not been hawkish and it's not been dovish, but that's where I see it. You can see it differently. Well, we all see things differently. That's why. So I believe he's trying, to kick the can down the road again. That's what he always do. It's not been confirmed yet, right? But I believe it's going to be confirmed. But so it's just playing nice, because he's surrounded by politicians, and politicians don't, midterm election is coming as well. It wouldn't crash the market before midterm election. So he's trying to save the day. That's what he's trying to do. But I want you to listen to the next one and to see what he said.
To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments, so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals.
Well, guys, you've heard from the horse's mouth, so I don't need to reiterate or just to reconfirm what he said. You saw it yourself, but there's some analysts that see this thing differently, and I want you to watch them as well. Then I'll make my last comment. Thank you.
I thought he did pretty much what he told us was going to happen. I thought it was pretty much hitting the nail on the head. A little bit, maybe a touch more hawkish in terms of releasing that principles of balance sheet reduction. Not something I expected, but I did expect him to talk a lot about the balance sheet, so they just did it in a more organized way than I think the market expected. I think I had an expectation that perhaps this summer they would be reducing the balance sheet, hiking in March, so I think it was pretty much spot on. I will tell you, Melissa, in just the last, little bit here, with this rise in rates, I want you to look at the Fed funds probabilities, because there has been a change in the market outlook. We went into this meeting with the expectation that rate hikes would be quarterly next year. They've now moved that up. If you guys can show that chart, thank you very much. There's now a banking here or pricing in of 3 consecutive rate hikes with only a break before the 4th here. Now, it looks like that June one could change a little bit. It's not quite as strong as the others right now. And this is pricing that does move around, sometimes by the hour, sometimes by the day. And you can see the November hike, or the 4th hike, is now in November. It had been in December. So they've made more, the market now pricing in more frequent rate hikes, as well as an earlier 4th hike there as well. So I'm not sure I heard that, but I can get how that could happen, that the market thinks the Fed's going to get its business done. Maybe the upside is I don't see them pricing in a 5th hike here, at least not at this point yet, at the February or December meeting. So pretty much as expected. I'm a little bit concerned that there were a lot of people out there saying that they thought Powell was going to ease off and be dovish. I don't know why they expected that. I'm a little concerned that people were talking about that out of school a little bit.
Well, friend, you've had them, and I just think, to me, what I see now is I think market's going to be all over the place like we've been seeing since Monday. It's going to be all over the place. Dollar cost average, buy into solid company. If you want to buy into energy, banking, and all that stuff, buy into this. Not the time to be buying, some random company just because somebody tells you to buy into solid company with low PE ratio and big market cap and all that stuff. Microsoft came out with their report and it was, on point. The day after, the Microsoft stock went down, and later on it was up. And through that, I was dollar cost averaging, and before I know it, my Microsoft position is green already. So try to dollar cost average all through this time, because we don't know how many times they're going to be raising rate, and every time they raise rate, market is going to go down. So you don't want to dump all your money at once. Buy steadily, and when the market reverses, you'll be happy that you've done a good job for yourself. So guys, I don't want to waste your time. I don't want to bore you. My name is Peter Ads, and I'll see you on the next one. Bye for now.